Hey everyone, and welcome. So, you're earning some money from a rental property here in Canada. You are in exactly the right spot. Today, we're going to break down two really important lines on your tax return: 12.599 and 12,600, which cover your gross and net rental income. Okay, but before we dive into all the jargon in the numbers, I've got to ask you a really important question. Whether you're a seasoned landlord or maybe just renting out a spare room, there's one super common mistake out there that can have, massive financial consequences. And by the end of this explainer, you'll know exactly what it is and, more importantly, how to avoid it. All right? So, to even start reporting your rental income the right way, we first have to get on the same page about what the Canada Revenue Agency, the CRA, actually considers rental income. The CRA definition is, it's incredibly broad. This isn't just for those full-time landlords with a portfolio of properties. Nope. This also includes the income from that basement apartment you've got, or a secondary suite, or even just a single room you're renting out. The key thing here is that you're earning income from a property that you either own or have the use of. Okay, so let's get right to the heart of it. Your tax return doesn't just ask for one single number. It actually splits your rental income into two totally different categories, gross and net. And believe me, understanding the difference is absolutely fundamental to filing correctly. This side really breaks it down perfectly, doesn't it? So you've got line 12,599. That's your gross income. Think of that as your top line number. Every single dollar your tenants paid you before you take out a single thing. And then there's line 12,600, your net income. That's the bottom line. The actual profit you end up paying tax on. So you might be wondering, how do you actually get from that big gross number down to the smaller, much nicer taxable net number? Well, the magic for that happens on a specific form. It's called the T76, the Statement of Real Estate Rentals. You can just think of this as your official worksheet for figuring out your rental profit, or, sometimes a loss. So how does this T776 form actually work? Well, it's pretty straightforward. It's the place where you list out all of your eligible expenses. And this is key. Every valid expense you claim directly lowers your net income, which, you guessed it, lowers the tax you have to pay. And here are some of the most common expenses you'll see. You can deduct things like the insurance on the property, your property taxes, the cost of advertising for new tenants, even things like utilities, management fees, and the interest portion of your mortgage payments are deductible. This is why it is just so vital to keep detailed records and receipts for everything throughout the entire year. Okay? I need you to really pay close attention now. Seriously, because this next part, it's probably the most important takeaway from this entire explainer, especially for any of you renting out a part of the home you actually live in. So here's the deal. When you change how you use a property, say from personal use to something that's making you money, the CRA can treat it as if you sold that chunk of your home at its current market value. This is what's called a deemed disposition. And man, it can trigger a huge capital gains tax bill that you were absolutely not expecting. But thankfully, there's a way around this. The CRA has an administrative policy that lets you avoid this whole mess. And this is a big but only if you meet all three of these conditions. First, the rental part has to be ancillary, which is just a fancy way of saying it's secondary to the main use of the property as your home. Second, you can't have made any big structural changes like building a whole separate apartment. And number three, and this is the big one, you do not claim something called capital cost allowance. Now look, all three of those conditions are important. But one of them is an absolute non-negotiable ironclad rule breaking. This rule is that single most costly mistake we talked about at the very beginning, and it can completely wipe out one of the single biggest tax benefits of owning a home in Canada. And here it is. This is the big one. Never, and I mean ever, claim capital cost allowance or K on your principal residence. So what is CA? It's basically a deduction for depreciation. Wear and tear on the building. And yeah, it might give you a tiny tax break today, but claiming it completely voids your principal residence exemption on that part of your home. Trust me, this one mistake could cost you tens or even hundreds of thousands of dollars in capital gains tax when you finally sell your home. It's just not worth it. Okay, so now that we've covered that super critical warning, let's switch gears a bit and look at a few best practices. Some pro tips to help you manage your rental property taxes like a pro, both for this year and for the future. All right, let's do a quick recap with a few key reminders. First, if you're renting to family members, you've got to make sure the rent is set at a fair market rate. If it's not, you might not be able to claim your expenses. Second, always track your income and expenses for that 77.6 form. And just one more time because it's that important. Avoid claiming CA on your principal residence, please. Now, thinking a little more long term, if you hold on to a rental property for many years, chances are its value is going to go up maybe a lot. This creates this big unseen capital gain that's just sitting there, and it will become taxable when you sell or when you pass away. This is where proactive estate planning can be a lifesaver. It can help you manage that future. Tax it in a really smart and efficient way. So let's leave you with this final thought. Is your rental property actually future proofed against these kinds of tax surprises? Seriously, thinking about these things now can save you and your family a whole lot of stress and a ton of money down the road. We hope you enjoyed this podcast. Would you please click the like and subscribe button so you receive future releases and for the podcast to your friends, family, and colleagues. This presentation is for the audience general information only. Please consult your accountant for professional advice. You can visit our websites, ifmsolutions.com and disabilityrefunds.com. At IFM Solutions, you will find out about our accounting, bookkeeping, payroll, and advisory services. Our Disability Refunds website has a treasure of information for people with health issues and their family members, especially those wishing to apply for disability tax credit and CPP disability. For any comments, suggestions, or to contact us, please reach out at 1-855-786-4786 or email us at info@ifmsolutions.com. Thank you. See you next time and take care when filing those lines. Bye.
IFM Solutions and Disability Refunds.